You were not meant to be a slave to the grind. You were not meant to trade your life force for money. You can escape gravity. You can unlock your life. You got this. Let's go.
Hello and welcome to Unlock Your Life. I'm your host, Jennings Smith. Today it's just me and you, and I have something important to talk to you about that most people are interested in, and that's how do I get in my first deal within 6 months? I don't want it to take forever. I'm looking to make the leap from single family into multifamily. And how do I do that? What do I need to know? And what's the quickest, most efficient way to get into that? So there's two tracks that you can run on. And I always encourage people to do both, but this is a little bit more efficient. So the first track would be finding a deal. And most people easily and quickly get on board with that. But the second track, which I believe is more efficient and is going to get you where you want to be faster, is looking at the down payment side, looking at the capital side. How can I raise capital to bring to deals, whether they be my deal or they be somebody else's deal? Okay. And so that's great in theory, but how do you actually make that happen? All right. I'm going to break it down into 4 components so that you can get started on your journey. All right. So the first piece of the puzzle is the foundation, right? We got to lay the foundation first. All right. The foundation is the concrete, the rebar, the dirt work. And there's 3 major pieces of that. I want you to think about education. This is, clearing the lot, getting the dirt prep, getting it ready to go. I was a builder, so I'm going to use some building examples. All right. So to do that, we've got to get a level of education. So in your first, month or 2, and you should continue this your whole career in multifamily, of course, but in your first month or 2, you want to get a grip on the basics. Now, single family, pretty easy to grasp. It's like, what's my mortgage? What's my taxes, insurance, my maintenance and repairs, and what's my property manager going to charge me? If I can rent it for more than that, then that's a decent deal. And I'll be able to pay my mortgage, cash flow a little bit, pay down the mortgage, and ride the appreciation wave, sell it in the future for a profit. That's the goal. And multifamily is really no different. You're looking at something that, can we rent this for more than it costs us in the big scheme of things, and cash flow positive? And maybe we can't do that day one, but maybe if we implement our plans, or we raise rents, or we lower expenses, or we do a value add, whatever it is, we can get there. And when we get there, then we can have a better net operating profit, net operating income, and we'll be able to sell this thing for more, or we'll be able to refinance and just hold it and pull the money back out, pull our down payment back out. So education is important in multifamily because it's a little bit more complex on how to underwrite these deals. Underwrite means you're analyzing the data. So you've got to look at all the components of that. And this show is not going to focus on underwriting today, but you're looking at, how do I underwrite a deal? How do I see if it makes sense? How do I do market research? What markets do I want to invest in? What's realistic for where I can get these rents? What's a realistic expense ratio? What is this thing really going to cost to operate? And how long is it going to take? And what kind of returns can I get? Because now you're involving the third party, you're involving an investor. Maybe when you're buying a single family home, you're just using your own money for the down payment, and you don't have to worry about necessarily paying a return to the investor until the very end when you make the profit. But in these deals, those investors are going to, most of the time, want monthly or quarterly payments. They're going to want some return on their money, and they're going to take a bite of the apple, right? So how do you structure all that? What are the legal ways to do it? So if you're raising capital and you're pooling people's money and you're buying assets, how do you get educated on how do you do that legally? What's a private party or private placement memorandum? What is the operating agreement? What does that look like? How do I structure that? And so there's a lot of education that goes into multifamily. And I'm not saying it's super hard, but it's more than just a simple grasp on single family rentals. But education is the foundation, right? It will not get you there, but it's where you start. You can start on YouTube. You can start in Facebook groups. You can buy online courses. I have a course that I provide in the deal room where people can just watch 100 videos and learn A to Z, the fundamentals of how to do this so that they can understand this, because we're going to build on that. And it's going to become very important to have education, because I want you to think about this. Let's say you go out there and you raise capital for a multifamily deal, but you don't have education and you don't know what a good deal is, and you're not able to correctly underwrite it, and you're believing other people and what they say, and they may be too optimistic, right? They may be flat out wrong. Maybe their market research is flawed. And if you don't know how to do that kind of thing yourself, you could be putting your money at risk. You could be putting your investors' money at risk, and that's not a good thing. So we've got to work on that education piece and the adage, invest in what you know. So if you don't know this asset and this asset class and how to do it, you may not have the best results with doing that. Okay. So second part is the network. Okay. So the network, we're going to say that's the rebar. We're dug our foundation and we're putting in the rebar. This is our network. Network is important because you've got to have multiple parts and pieces in a multifamily deal. You have to have a loan sponsor, right? Somebody that can help you get the financing. If you're not able to go close a $5 or even $2 million deal on your own, you're going to need somebody with the balance sheet, net worth, and liquidity to get that loan across the table. Balance sheet being they've got assets already in excess of the loan, right? Their liquidity, they've got cash in the bank, enough to cover 10% of the mortgage balance usually. So a $2 million loan, they've got $200K in liquidity. So you're looking for somebody like that unless you can check that box yourself. But the network is important for that component. The other component is you're going to need people that are getting deal flow. Maybe they have a better relationship or they're more established with brokers or wholesalers or off-market deals or even on-market deals, but they have those opportunities and they're looking for people to help them, right? And then third, so that's your network, right? We're in the foundation. We've got our education. We're building our network. We're plugging into that. And how do you get a network? Network is earned, right? It's relationships, and it takes a little bit of time. So there are networking groups. There's real estate groups. There's Facebook groups. I mean, I have my first million in multifamily. There's people in there. I have the deal room, which has 300 and something people in there. And that is a network of people that are actively looking for deals, looking to put money in deals, raise capital for deals, sponsor loans, that kind of thing. But getting that network, wherever you get it, is a critical piece of multifamily because this is a team sport. It's very difficult to go from nothing to a deal in 6 months with no network, unless you are just independently wealthy and you get very, very lucky and a deal comes across your plate. Third part of the foundation, this is the slab, right? We're pouring the slab. This is our partners. So this is like the level above the network, right? The partners. Out of those networks that you've built, who are you actually going to partner with? And identifying, here are 2 or 3 groups of people or 2 or 3 individuals that I like them, right? I like their moral character. I like the types of deals that they like. I'm kind of attracted to mobile home parks and they like mobile home parks too. And I think I can attract capital for mobile home parks. So that's a good fit. They've got a good reputation. They've been doing this for a while. They know what they're doing. They're certified closers. They're great operators. Whatever it is, the partnership is extremely important to find the right people and vet them out, doing your due diligence, asking around multiple sources, digging on the internet, just trying to find a reason to say no, right? A reason that you don't want to partner with this person for whatever reason. But if you can identify, 1, 2, 3 groups that you are intrigued by or interested with, you can move on to the next phase, right? So we got the foundation laid. We've educated ourselves. We're continuing doing that. We've got the basics down. We're plugged into a network to bounce ideas off, check our underwriting with them, check our assumptions, hear their input on deals. We've also identified and done our due diligence, our investigation on a couple of partners. We move on to structure. So think about framing the house, right? Now we're going to get out the 2x4s and the rafters and start framing this house. So the 4 types of components that are in the structure are deal type is number 1. So what type of deal am I attracted to? Do I want to do Class A, nice stuff in established areas? Maybe the returns are a little bit lower, but they're safer, right? They're in an area like Orlando, Florida, where a lot of people are moving there. They've had great population growth, but there's not a ton of upside. Like we've got to pay top dollar to get these properties, and we're really banking on holding it a long time, and appreciation is going to be our friend. There's not going to be much cash flow on this deal. Maybe that's what you're attracted to. Maybe you're attracted to, like I said, mobile home parks, which are more of a cash flow play, maybe not as much appreciation, but you like that. You know, you see the numbers and they make sense to you. And so you're attracted to mobile home parks. Maybe you've got a background in managing parks, or you've done some trailer rentals, whatever. I don't know why, but you have an affinity towards that. Maybe you like self-storage. Maybe you like C-class apartments that are a little bit rougher and they're going to take renovations, and maybe you got to turn the tenant base over, and maybe you've got to manage it with a stronger arm, but the returns could be better in a C-class. Maybe you're looking for like distressed stuff, like it's half empty and there's a real big value add, but there's a lot of risk. There's a lot of work to do, and you're going to have to fill this place up, and it's going to take time and effort and money, and it's going to be very capital intensive, but you know that there's a big payoff at the end. So I'll give you an example. I did a deal like this in Oklahoma. It was half empty and it needed $2.5 million worth of renovation, plus $5.5 million worth of purchase price. Plus there was carrying costs of paying the loan and paying the investors while we were stabilizing. And so a lot of risk and sweat and blood and tears went into that deal. But now on the back end, it's full, it's renovated, it appraised for $14 million. We refinanced it at $9.5 million loan. So we paid all the investors back their money. We paid off our primary loan. There's $4.5 million in equity there, and it's cash flowing. And it turned out to be a great deal. However, it could have gone sideways with the wrong operator if we didn't fill it up, or the renovations went way over budget. And we did hit snags in the road. That deal was not easy. But those are the deals that can go sideways very quickly because there's not a whole lot of existing in place cash flow. And from my opinion, the best deals to find are ones that are full, they're cash flowing, but there's operational plays, right? You can bump rents, they're under market rent. You can add a utility bill back. You can charge pet fees. You can lower expenses. You find creative ways to do that. So those have a lot less risk, but everyone's looking for those deals, right? They're a little harder to come by. Okay, so think about the deal type. And this is part of, with picking your partners, but you're going to go this deal type because you believe in it, you like it, and this is what you're going to be presenting to your investors. Okay, moving on to the second part of the structure is, how are we going to structure these deals, right? How do these groups that I'm getting involved with, or if I do my own thing, how do I want to structure the deal? So there's a lot of ways to structure a deal, really infinite ways. So there are some common ways, and I'll go through those right now, and you can sort of see what resonates with you. So the most common way to structure a deal is the typical syndicated model. That is where you give away 70, sometimes even 80% of the equity of the deal to the investors. They also get a preferred return, usually pretty low, 4, 5, 6%, which is a percentage on the money that's invested. And that clock is always ticking, and that's got to be paid first. That's what a preferred return is. Then after that's paid, then you split the profits 70-30, 70 to the investors, 30 to you as the syndicator. So there's ways to structure that, though, where you get a little bit more money, right? You're building in asset management fees. You've got acquisition fees. You may have disposition fees. Maybe you have a hurdle where after the investors make 12%, then you split the deal 50-50. There's a whole lot of ways that you can iterate that structure, but that's one structure. Another structure would be flip that on its head, right? Where you're getting 70% of the equity on the deal. The investors are getting 30%, but you're paying them a heavier preferred return, right? They maybe are getting a 8 or 10 or even higher preferred return. So they're getting the first 10% on their money, And if the deal only makes 10%, then you don't even get paid. You owned a lot of the deal, but there was no money to be made. It all went to the preferred return. It all went to the investors. And so it's a way to build a lot of equity, but it also can have you working for free if you don't use that strategy on the correct deal. I see that strategy work pretty well on deals that can be BRRRR refinance, like, buy, renovate, rent them out at a higher rate, and then refinance. So you've got velocity of capital. You're returning the capital very quickly to the investors. You're paying them a preferred return, but you got to be able to refinance it fast so that you can get that preferred return off your back and get that capital back to the investors. But that is a very unique strategy. And most people that have been in multifamily for a long time, like limited partners, they may not like that deal because they don't have as much equity. Even at the end of the day, they may make the same returns or more. It's a little bit of a foreign concept. I like that structure because if I buy something that's a heavy lift and it's going to take a lot of work, but I can get it to refinance in 2 years or so, I'm going to be able to retain a good bit of equity. The investors are still going to make a good, safe return and they get paid first, but I'm not giving away the whole farm. Okay. Another deal structure could be, you might just do straight up 50-50, right? You get 50%, they get 50%. There's no preferred return. You just split everything. Or you could do 60-40 or 70-30 to them, 70 to them, 30 to you, no preferred return. I like that model because, you're all in it. And if they get paid, you're getting paid. If they get 70% of the cash flow, you're getting 30% of the cash flow. And you're not as bound by that preferred return hurdle. Another way you can do it is you can raise the down payment as like mezzanine debt or private capital. So let's say you're buying a $2 million property, you need a $500,000 or $600,000 down payment. You might be able to find people that will loan you that money for 2 or 3 years at 10%, 12%, 14%. And depending on how good of a deal that is and how well it's cash flowing, that might be a way to buy something. In the first couple of years, most or all of the cash flow is being diverted to that hard money lender or mezzanine lender in second position. But once you get them out, they're out, right? They don't own equity in the deal. You own the deal 100%. You've refinanced them. You've got the rents where they now cover your new debt and you own that deal outright, which is cool. And I've structured some deals that way. And there's many, many other iterations, seller financing, seller carryback, all that. I mean, I can't get into all of it today, but there's a lot of ways to skin a cat. And this goes back to the foundation and the education. So figuring out how you want to structure a deal and the kind of structure that you're drawn to is an important part of that. Thirdly, in the structure, you need to figure out how are you going to get paid. You need to have the discussion with your partners of, if I'm coming in and I'm going to do maybe I'm going to do the boots on the ground, right? I live local to the property and I'm going to be there once a week, checking on the contractors, checking on the property manager, and that's going to be part of my deal. I'm also going to raise some money for the deal. Maybe you're going to help with the asset management. Maybe you're in finance, right? And you're going to help them get the loan. Maybe you're an insurance expert and you're going to help with that part. You're going to run the due diligence. It depends on your skill set and experience level, what parts and pieces that you're going to have. But in this one, we're talking about raising capital. So you want to know, okay, of this 50% equity that's going to the general partners, or 30% equity or 70%, whatever it is, how much of that is the capital raise piece worth? And usually it's worth a good bit because that is a very unique skill set to have and it's very valuable. I mean, imagine, right? Imagine you have a deal and it's a great deal and you've got everything lined up. And if somebody walks in and says, man, I can bring your whole down payment, that person is valuable to you, right? You are going to want to connect and possibly partner with that person. And so this is where you can get a piece of the pie. Now, there's a caveat here that can't be your only piece, right? There's SEC rules about that. Being a strict capital raiser and you're just kind of brought in as a hired gun to raise capital after the fact is not permissible, right? You need to be part of that team from day one. You need to be part of the due diligence, part of the research, part of the asset management, and so on and so forth. And personally, that's the way I prefer it. I don't like to be just a hired gun to raise capital for a group that I'm not very, very versed in that deal and very, very understanding of the parts and players and the due diligence and making sure that this is a good deal that I want to put my investors' capital in. So I won't be a hired gun. I just don't like that. I want to be in the weeds with the group on it, which goes back, of course, to education. And then the fourth part of the structure, right? Okay, now we're framing up the roof. We kind of already hit on this, but like, what are your roles? Like, what's your role going to be in the structure of this deal? Where are you going to add value? And the more educated, experienced, the bigger network you have, the more investor base you have, the more valuable you are, right? And that translates usually into equity, okay? All right, so we're moving on to being prepared, right? The third part. So this is, we're closing the house in. We're putting the roof on, we're putting the siding on, we're putting the windows and doors in, we're closing the house in. We're putting all the skin on the house, the siding, the windows, the doors, the roof. And this is super critical. There's an old adage that if you find the right deal, the money will come. And I think there's definitely some partial truth to that, right? If you have to have a good deal for money to be interested in it. You have to have a solid team and deal and operator for that to happen. But to think that all you have to do is just throw a good deal out there and money will be thrown at you, it's not the case. There's a lot more to it. And a lot of it is building those personal relationships, instilling trust with these investors through multiple conversations, going over and going through potential deals, past deals, sample deals, and digging that well before you need the money, right? Because once you go under contract, the clock is ticking. You've got 60 to 90 days to close that deal. And if you don't get the money raised, then you're going to not close that deal, which nobody wants. So pre-raising is very, very, very important. And I would recommend that you start pre-raising after you've got step 1 and step 2 in, right? After you've got your foundation laid, your education, your networking, you've identified a couple partners that you like, you know what kind of deals you like, you know how you're going to structure these deals, and you know what your roles are going to be. And that way you can make like a executive summary. It's called a sample deal sheet, a sample deal where you have, hey, this is a deal that it's not a live deal. We passed on this deal, or we bought this deal in the past, but if we were to structure a deal, this is how it would look. And you kind of go through, this is the business model, this is the plan, this is how we would operate it. This is how the investor would be, or their role. This is how they'd get paid. This is the amount of equity they would get. This is how the preferred return would get. For every $100,000 that was invested, these are the kind of returns that we would project. And it gives you an opportunity to have the confidence to have these meetings with investors, to sit down and start building that rapport and building that relationship so that when you have a live deal, you have something ready to go, you've got 10 or 12 people that are interested potentially in something that you have. And it's really easy to have these conversations because there's not a whole lot of pressure on you and there's not a lot of pressure on the investor that, hey, we got something under contract. I need you to invest in this right away or we're not going to be able to close this deal. They can sense that. They can sense that fear, that urgency, and that does not translate well. So pre-raising and having these meetings is extremely important. And if you want a sample deal, like a pre-raise deal, where this is an example, I can give you a copy of that, right? I can give you a copy. Just shoot me a message and I'll send you over a copy of like our pitch sheet, pitch deck of how we would go about that. And you can tweak it, adjust it to how you would structure your deal, but it's kind of a cool tool to look over. But the pre-raise is getting everything prepped and dried in and ready to go. And that way you can move to the interior, right? Because you don't want to start hanging sheetrock and putting in floors and cabinets and trim when you don't have a roof on the house, right? Which is your pre-raise, when you don't have your windows and doors installed and the rain's coming in and wrecking everything, right? You want to have that buttoned up, ready to go. Now we're in the execution phase. So execution phase is your partners, or maybe even you, if you've been looking for deals at the same time, you're executing, you're putting something under contract, right? So you've put something under contract and you're putting together your marketing materials, you're putting together your PPM, your private placement memorandum, your legal documents that you need to legally do the deal and raise money. You're getting your loan lined up. You're walking the property, you're walking all the units, you're analyzing the rent rolls, you're making sure that sellers aren't lying to you or hiding something or whatever they're doing. You're verifying all the income, you're verifying all the expenses, and you're making sure that this is a deal. And after you get through your due diligence period, you're pretty certain that you're going to close that deal. You may have money at stake and the money goes non-refundable after the due diligence period. And whether you do or not, you still haven't closed that deal and you still can walk away from that deal, right? It's better to lose 50 grand in earnest money than to lose 500 grand on closing a bad deal that doesn't cash flow and becomes a massive nightmare, okay? So always be willing to walk away from a deal if you have to, okay? But let's say it's looking good, because at some point you've got to say, all right, we're closing this deal. We've gone through due diligence. We've done everything we can. We've vetted out all the numbers. We've vetted all the details. We've walked every unit and we've done our market research. We know that our plan is as sound as we can make it, right? With the information that we have. That's when you start raising the capital, right? You've already been building your market materials. Now you've got your structure set up. You know what your returns that the investors can expect are going to be. And now you're going back to your pre-raise well and saying, hey, I got something. I know we've been talking. I've been in contact with you every couple of weeks. Well, now I've finally got a live one. Do you want to see it? And hopefully they say, yeah, shoot it over to me. And this is where I'm going to give you a little tip. I would recommend that you set up a call, right? Set up a Zoom or go over there if they live by you, whatever, but meet with them, because that's a precious thing, right? You've got somebody that has capital, likes real estate, wants to invest, and is looking for a good opportunity. And if you just shoot them over something and they look through it and they see something that they don't understand, or maybe they don't like something about it, but there's a perfectly good reason, you're going to be there to help them overcome that objection or explain it. And maybe they still don't do it, which is fine, but at least you have a shot at it. And I think it's much better to be there in person, explaining your vision, why you like this deal, why you're excited about the deal, why you think that it's one that you put under contract and you want to put money behind. And that's where you're executing. And this cannot be stressed enough. I believe all members, all parties of the general partnership should be out there executing on the raise, right? I don't think that it should be all on one person, especially somebody that doesn't have a big track record, because you're putting a lot of eggs in that basket. So when we close deals, it's kind of all hands on deck. Let's all raise the money and get it done. Okay, so execute. And the second component of that is don't overpromise and underdeliver. Remember, you maybe are in month 5 or 6 or 7 or 8 of your journey, and you've been working diligently, you've been building your network, but don't overpromise, right? You haven't done this before. You don't know how hard it's going to be or how easy it's going to be. Maybe it'll be great. Maybe it'll be easy. And no one ever got mad at the person that raised too much money for the deal. Just remember that. It's always a good thing to have oversubscription, overraise, overabundance of capital. So if you think we need to raise $1 million for this deal, and you're like, oh, dude, I can get $500,000. No problem. I've got 12 people that were committing $100,000. I should be able to raise $500,000. No problem. And if you've been doing this for a while, I would say that that's probably right. I would say about half of them would be good with the deal. But if this is your first go around or second go around, and you're getting into this, maybe tell the partners, hey, I can commit to 250, 200, 250. Let me start with that. And maybe they push you. Maybe they want you to do more. Maybe you're not getting as much equity as you'd hoped because you're not raising enough money to get the equity that you wanted. If you come in there with 500,000 later, I think they're going to be just fine with it, right? And a lot of times this raising is first come, first serve. It's like if they sign the paperwork, your people sign the paperwork and they wire in, they're in the deal. And all the time, investors back out, they flake out, situations change with their finances where they don't want to do it anymore. There's a million reasons why people don't invest. A lot of it has to do with timing, but executing and not overpromising is a great way to build that solid bridge with your partners where they know, okay, we can count on you. Look, she said she could do 250 and she did 250. Great. Or she said she could do 250 and she did 350. Awesome. That's even better. And if you have too much money, you can roll that investor into the next deal, which is also a great problem to have. So guys, there you have it. Start with your foundation, which is your education, network, and partners. Next move is structure. How are you going to structure this? What kind of deals do I like? How am I going to get paid? How are the investors going to get paid? What are going to be my roles? Thirdly, get prepped, pre-raise, have those meetings and be ready to go. Have your roof on so that when the time comes, you can execute. Execute being the final step, and getting the money in, having those investor meetings, getting them to commit to the deal, and not overcommitting yourself and looking bad on the other side. So if you need help with the foundation part, that's where the deal room comes into play, right? We have a $2,000 course that we provide at no cost. We eat the cost of that to everybody that joins the deal room. They plug into our network of loan sponsors, capital raisers. They plug into our network of people that are out there actively finding deals, analyzing deals every week. We're going on weekly calls where we're talking about live deals. We're talking about strategies, how to structure them, how to do seller financing. We're picking these deals apart. Hey, did you think about this? Did you think about that? I think your expenses are a little too high here. I think maybe you could get more rent there based on this market data, et cetera, et cetera. An expert looking over live deals. And this is where you find partners, right? Hey, this guy's got a live deal. He seems like he knows what he's talking about. Let me build a relationship with him or her. Let me go to a conference and hang out with them. Let me jump on a Zoom call with them, whatever it be, because these partnerships can be life-changing, right? And they need to be the right people, but you got to put yourself in the position to meet those kind of people, interact, and build that base. So if that's something that you're interested in, jump over to my website, Jennings Smith Jr., JenningsSmithJR.com, and there's a lot of info there. You can look at our free Facebook group. You can look at the application for the deal room. You can see how much that costs. You can also check out our video, how can you earn $10,000 a month in passive income off of one apartment deal? And we have a case study that breaks it all down. So guys, have a great week. I hope you're doing well, and don't forget to unlock your life.
This is thepodcastfactory.com.